Hello, welcome back. I'm Dr. George Mochocki. I'll be your facilitator for this session that we'll be covering today. This is a course, Marketing 106, Retail Merchandising or Management, offered by Harper College. You're either taking me online, face to face, or a blended class. So we already discussed this in the class. You already did the reading from the book. You ready for the lecture? Just going to be a quick overview. Now, this class here, this section here on Chapter 12, we're going to talk about operations management and financial dimension. Basically, a little finance, accounting, how to budget on a simplistic level. Many of you are just being exposed to this for the first time, so I don't want to overwhelm you, but I do teach finance, so I'll try to keep this real simple so you can kind of understand what am I getting into when I'm opening up my business or I'm a manager managing a department or a store or a chain, and I have to know the budget, I have to know the financing, I have to know how to improve productivity, everything that we're going to be talking about. Okay, so let's get right to it. And we're gonna let me make this a little bigger so you can see it, and I'll do it at 200. I think people can see it better that way. All right, so we'll go through this. Make sure you use the concept maps. A lot of times, my concept maps are only in the first tier, so you have to add on to it. Remember, everything that you part of the learning process. The more senses you utilize, you're listening to me, you're reading the book, you're writing things down. All those senses, we're trying to get it to the long-term memory. Okay, so what are the learning objectives of this course? Define the operations management. We're going to talk about that. Discuss about profit. That's the whole thing about business. Describe asset management. So what do I own? Look at retail budgeting. You have to budget. You have to look at what you did last month or last year and make sure you're at least on track because it pays your bills and everything else. Examine resource allocation. Is which resources do I utilize? Which resource could I put off for a future date? Okay. So now let's go into operations management. Operation management, how does a store operate? Who does what tasks? What time are we open? Where do we put the displays? Where do we keep the inventory? How do we bring new inventory in? I mean, I have to be efficient and effective so I satisfy the customer. How do I send stuff to them? How do I notify the customer? All this is the business side. This is the whole operation. If you look at from a manufacturing, you have a statistical, and a conveyor belt. You know everything that goes on. Take the same kind of a logic and rationale and you take it to a business or a service organization. Here you're basically looking at it as a process, different processes. So how do I make the business operate? And I look at, does it take too long? How do I outsource some of the stuff? Do I do some of the stuff myself? Do some of the stuff do I put off till off hours, or I do it when the stores close? All these things I have to think about. But the whole thing about operation management is that I'm planning ahead, at least a couple weeks ahead. I'm looking at my assets management, my resources, that I'm utilizing them effectively. I budget and I resource my allocation. So let's look at profit planning. Remember, I'm just giving you a quick overview. The book has more detail. I'm just whetting your appetite. Ooh, take this class if you're already taking this class, you're looking at it. But since it's a YouTube, someone may else look at it. So take this class, retail merchandising at your community college or at a four-year university. Community college, you get the best bang for your money. Okay, so profit and loss income statement. Basically, that's your income statement, how much money I'm making, and how much I've lost. I'm making a lot of money, but I don't have anything at the end. So I'm basically not making a profit. Okay, the whole thing of the profit and income statement is how am I utilizing my money. And income is, to me, is my income, is my wages. For a store, it's my revenue coming in. And summary of revenue and expenses, you got to know how to minimize that over a period of time. It's usually monthly, quarterly, or yearly. Some businesses do it weekly. Especially small businesses. You have to know. You're keeping your eyes on. You don't wait till the end of the month, find out you can't make your bills. Review overall specification, similar profits and profitability. So you look at last year to see what that you're at least making the same thing. Because remember, in the business cycle, it's not going to be all the same amount over the whole year. You have your ups and valleys depending on your business, depending on the service and the product that you're selling. Okay, so now if I'm looking at a profit and loss statement, here are the components of it. I'm just going to go over it. Make sure you know net sales is how much. Basically, it tells you is revenue by a retail during a given period of time after deducting customers' returns, markdowns, and employee. It's like a farmer. I put everything else after I paid everything else off. How much did I have left? how much sales did I have? I sold it, but he brought it back the next day. Oh, it was broken. I had to return it. All that affects my sales. You remember? So when I'm looking at my income statements and my net sales, I have to get rid of this stuff and bring it down so I actually know what I actually did sell and what came back. Okay. Now, cost of goods sold. Now, this is a little bit complicated. It requires the merchandise sold during a given period. And accounting go through. If you take me for finance, I explain it. If you've taken business 111 or management 111, in the accounting section, they went through the cost of goods sales. There's a whole section on that. Just understand, I buy something, and when the cost of goods sales sold is what I paid for it. Not, you know, I mean, later on you'll get how much is revenue, but this is your own cost, your own inventory turnaround. I'll leave it at that because I don't want to confuse you. I had to go through the whole thing. I only have a half an hour. We discussed this in class for those who wanted to know. Okay, gross margin, the difference between net sales and the cost of goods sold. And then if you look at the uh, uh, your income statement, it'll basically have. I didn't have I may have an example. The book had an example, so you see how it goes, but didn't exactly show you how the cost of goods is calculated. It's every month. I buy so much. I always have to have so much inventory to satisfy what I think my customers' needs are. But then next month when I buy it, maybe the prices went up or the price went down. Remember the Trump administration? If I'm buying a lot of stuff from China, by the end of March, if they don't come up with an agreement, then it's going to be basically my cost of goods are going to go up. So what do? It cuts my margins in my profit, or do I raise my prices up, or do I find another supplier? Okay, and then taxes, like it or not. Uh, 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 Remember, when I bring President Trump, some like President Trump, some don't. I'm looking at this from a business perspective. He cut taxes, he cut regulation, he reduced taxes. That means I have more money in my pocket. I have more money in my pocket as a business owner. I could give you a raise. You have more money in your pocket because he reduced your. I don't know if he reduced it. I haven't done my taxes yet, but so they say they reduced it. So now I got. He got rid of some deductions, but he gave me. A flat fee that I could write off, for lack of a better word. I don't have to itemize because he gave me a larger amount that I could write off on my taxes without itemizing, doing a quick form, make it very easy. So now I have more money as an individual. That means I could spend it at the shop I'm working at, or I could spend it at my competitor shop or other shops on there to stimulate that. So we're doing pretty good. And then if I'm looking at net profit, this profit earned after all costs, and then after tax have been deducted. That is your profit margin. This is the money. This is the money for your corporation. How do I break it up into dividends, or do I do it to reinvest to pay off, for later expansion, reinvest the money, or do I put in sinking fund to sinking fund? I almost said stinking, but sinking fund to repay my bonds or any kind of debt that I have in the future. Okay, so now the other thing they're going to talk about is increasing profit. You increase sales by by private labels. I bring the brand labels like we talked in class to bring customers in, but then I have a lot of private labels, my own brand that I made or somebody else's brand that I'm selling at a lesser cost but the same quality goods. It's just look, instead of buying an iPhone, I could buy a Samsung comparable. Oh no, I want an iPhone because peer pressure and all that, and status symbol. An iPhone is basically a status. Like an iPhone, that means you could afford $1,000 or 14,000. It makes you think like you're in a higher status that somebody else that you may not. That is just a show. Okay. You can reduce your operating. I can't raise my costs because of my competitors, right? So if I have a higher cost, I got to show more value. So how do I increase my profitability? I look at my expenses and then reduce the labor cost. Like it or not, the minimum wage brought up. A lot of businesses are automating. A lot of businesses are reducing staff. A lot of businesses are using more online or self checkout. All those things are to reduce the cost so I can keep my profitability. Remember, if I raise my costs up higher than my competitors, they're going to switch. This is America, capitalistic. They're going to drop me like a dime. That's the way I shop anyway. Okay. Now, asset management. When I look at asset management, here's the things. You got assets turnover, current assets, fixed assets, hidden assets, liabilities, what I owe. Okay, when I look at current assets, it's asset turnover is basically inventory turnover, or how quickly I turn the asset over to make a profit out of it. Okay, fixed assets is something that I can't, and then some of the asset turnover could be some like inventory was thrown in there that's within a year, or I try to turn it over as fast as I can to recoup my money, or I minimize the inventory I need, or I use just-in-time inventory, pay a little bit more, but I don't get stuck with the goods or products. Is that they keep the warehousing and everything there? I just call it in as I need it. Okay, liabilities is what I owe somebody else. Current liabilities, your current liability, current assets is within a year. Anything after a year is long term. And then you subtract your assets from your liabilities, and you get your net worth. And this is similar to how I look at my equity. What am I worth? Some people, got all new cars, new house, and everything else. Oh man, they're really rich. Okay, they've got the car and everything else, but what they owe, they basically are in the hole. And I don't have anything. It's everything on. They owe somebody else owns it. They're just paying like a lease agreement. They look good, but they don't own any of the assets. I think that's something like Whole Foods was there. They don't own their property or anything else. They just buy the inventory so that they could keep their costs reasonably a little higher because they're natural or organic, but still not that high where people can't, for lack of better words, afford them. Okay, and net profit is a performance measure and a retail balance sheet. And here's the balance sheet in here. You can look at assets. When you're ever doing this side, the assets and liabilities are their balance sheet, so they have to be the same. So that's why I know if you didn't get it right. See, here's the balance sheet here, and here's your net liabilities. These two numbers are always the same. All right. Remember, you get that more in accounting, please. I'm just going real quickly. I'm just throwing a lot of stuff at it. What I'm doing in this class, in the retail merchandising class, some of you have any accounting, no businesses. I'm planting seeds. Oh, I heard that, man. Got tired, but I understand that now. Okay, now the strategic profit model. When I look at this as net profit, sales, and everything else, and they're basically you're dividing the total asset by the network, and then you're going to get times, and then you'll get your return on your network is what you're looking at. It's a formula. I'm just skimming over it real quickly. And then if I look at increasing sales of private labels, reduce operating yourself, and we already talked about this, or online. Increasing asset turnover is inventory sells to a video. I got a real good video here with this gentleman here. Here's a link 24/7. I utilize my asset more effectively. I outsource for delivery. Have my own credit or got rid of my credit and use Visa, MasterCard. I don't use American Express because they charge a little bit more to me. And I said, okay, there's enough Visa, MasterCards out there. Reduce my inventory levels. Utilize second use locations. If I have another location, could I maximize it? If I got it and it's not fully utilized, maybe I use it for storage. Maybe I open up something just specific for that area. So I have an asset, a building, so I'm leasing. I'm only using 20% of it, or I rent out the rest. Come on, you have something that they're not utilizing all the time. Let's make some money off it. You're a business. You got to think, oh, the money coming in. It's not only the sales. There's different streams of income where I have ability to make money on money, okay, and utilize inexpensive fixtures. That's basically to increase. You don't need that real fancy stuff, but don't make it look junky. Don't make it look gaudy. You have to have something that kind of looks nice, kind of clean. And nowadays everything looks real fashionable and looks even a paint job will do nice on some of it. Other key ratios. The ratios here, these are just ratios. Current ratios, collection period, accounts payable, net sales, and overall gross profit. When I'm looking at ratios, you have to look at compare apples to apples. Inventory turnover. If I'm a car dealer, if I'm turning inventory, if I turn 4 cars a month, I'm good. You know what I mean? Because the expense, let's say Mercedes or BMW. Okay, that's a good thing. Now, so I have 4 turns of my inventory, maybe twice a month. Okay. Now, if I'm doing the same thing with produce, my inventory is terrible. If I got the same apples, oranges, and I only turn it over twice a month, I got old, rotten stuff. Something's wrong there. Do you see me? So when you're comparing it, I have to compare it with the same business similar. Then those ratios are just indicators. It's almost when they say, what's your blood pressure? So much over this. What's your weight? Here's what you should weigh at this age and your body frame and all this stuff. I mean? But you have to compare it to the same industry, because if I'm comparing one over the other, I can't compare a car inventory turnover or what they make under profitability versus a Walmart. They don't sell the cars, different models. Okay, all right. So we have that. So we have that. Okay, let's go in here. We're doing pretty good. This one I'm going quickly is, and the reason I'm going quickly because you'll have me for finance, accounting, so I don't want to over scare you. I'm just giving you a quick general. Okay, here's some financial trends. Walmart acquires Jetcom for $3 billion, and they're losing money. They did that because they used to be ahead of Amazon. Now they dropped. Amazon's beating them in overall sales. So now Walmart's trying to pick up this Jetcom, even though they're not making money. Remember, Amazon didn't make money for a long time until people got used to it. So this is Walmart. They have to be proactive. They can't wait till later on. Once those numbers drop and I'm losing sales, eventually I'm going to start losing investors. They're going to go someplace else because remember, investors only are buying the shares because they think the company's growing, and you give me you're making a profit, and I get part of those profits as a dividend. The economy growth, slow growth in the economy. This was in 2016, I think, when the book was written in 2017, if I'm mistaken. President Trump's in here. The economy, the Trump effect, is doing good. Economy's going good, going strong. Sure, you got a lot of unemployment's down. All the indicators looking well for me. Even with the China trade, the people are a little skeptical, but I think he'll get it through. He's a negotiator. Remember, whether you like him or not, I don't agree with everything he does, but the majority of the thing from a business perspective, he's right on target. Okay, cautious discretionary spending is when if the economy is bad. I think I'm going to lose my job. I'm watching what I'm spending. Funding resources. Again, people aren't going to give me loans even if I got good credit because they think the economy take a dip. If it takes a dip, people are unemployed. If they're unemployed, they can't buy my product. I can't sell my product. Manufacturer can't. It's like a ripple effect all the way through. Mergers. Maybe I'll merger with somebody else, bring another partner in, bring an angel investor. You'll learn that in finance if you take me in that. That's management 218 offered at Harper College. I teach you face-to-face, online, apprentice program, and a fast track. Hey, I'm selling here, right? Okay, bankruptcy. You have a lot of companies going bankruptcy. Sears went through a bankruptcy. J.C. Penney's is kind of on the hedge there. And so if I'm looking at bankruptcy, you go to Chapter 11. That means you get some protection from the court system, so creditors aren't after me, and I could get out some of my lease agreement. But the problem is, if I'm bankruptcy, they're not going to be funding me with a lot of goods because they figure if I go bankrupt, they could lose it all. It's a little, they just say, okay, we'll give you this stuff, only a smaller amount, or we want cash because hey, you're ready to go under. You may make it. All it does is keeps the creditors, like from financial advisor, keeps the creditors away from me so I could restructure my organization. Maybe sell some things, maybe get rid of some things, but I'm restructuring. Okay, during a strong economy, that's what we're doing good, so you don't have to worry about. The economy's weak or sluggish, following stagnant sales, cash flow, strong economy, high customer demand for my products, we're doing well. And look at that video when you get a chance on here. I got to give you the link. Okay? Okay, funding sources. You get it from mortgages. And this one here, I'll put it in there. Real estate investment trust, fund to trust. A lot of times what happens, they'll build the money and then they'll go back in expenses, or they have other, they'll put a trust fund to expand or renew my operation. I'll just leave it at that for now. Company dedicated owning and operating income producing real estate. Okay, initial public offering. Remember, company, a corporation offers an initial public offering. When you offer a new stock, anytime they need money, corporation has two avenues, just like we do as an individual. Debt financing, I mean, IOU or bonds, or they do equity financing. I sell something or bring in another partner. And if they need money, they'll do an initial public offering. The initial public offering, the money comes to the organization. After that, there's a secondary market out there. In the secondary market, as the company grows, I could sell it. Pretend you brought your house at 150,000. I can't find it for 150,000. Maybe 250,000 or 100,000. I got a million. $150,000. McHenry area. Okay, not around here. It's good. I don't think you'd find anything for 150. But you figure you paid 150,000, and then well, maybe you did 5 years ago, and now you're ready to sell it, and now it's worth 300,000. So you made that money. But now the first 150 goes to the developer. The next thing, when you're selling it for 250, you already paid off all this. Hopefully, if you got your loan all paid off, but you subtract what you own them, and that the rest is all yours. You remember you had equity 150, now it's worth 300. You had $150,000 of equity that if you sell this money, you could get. Don't forget the taxes. Remember, that's all before taxes and all that, and your income. Take me for finance. Okay, and then so that's initial public offering. Bankruptcy and liquidation. Bankruptcy allows retailer to basically don't worry about their creditors, but still doing a business. It's protection, gets out of leases, everything else. Liquidation. After that, I can't do anything else. I just sell it and I try to pay off. One thing you have to understand: who gets paid for us? The stockholders or my creditors? The stockholder, your owner of the corporation. Creditors get paid for it. They don't mean they get everything. They may get 10 cents on a dollar. They may get 50 cents on a dollar. They may get nothing. I liquidate. This is what you get. This is what I'm stuck with. This is all I got. So that's why a lot of times when it goes to the bankruptcy, the creditors and everything else will work with you because they don't want to lose everything. They say, hey, maybe he's got a shot. He just did something wrong. The same thing with stockholders. You have to, through your annual report, to send them a letter. Here's how we restructure. We think we're going to get rid of all our bad stores or low performing stores. We're automating. We're changing this. We're changing our mission. We have a plan. The court agrees with the plan or I agree with the plan. I will give you a chance if I think that your plan sounds feasible. Or I'll sell it and then take a loss, but then somebody else will buy it. Okay, so if I'm looking at budgeting, what do? Plan expenditures. I got a budget. Cost linked to satisfying the target market. I gotta see what we have there. I gotta reach out. So here's the thing. If you really look at it, the author did a nice job on that. You know, it just goes through. Those are looking through it. Okay. Now the other thing I'm looking at is benefits of budgeting. I could my expenditures to expect the performance. So I figure here's how, it's like I think I'm going to be working more overtime, or I've got other jobs. So basically, my expenditures are looking at my sales are going up. I could look at my sales and have a balance between my sales going up. Now I could do more and expand my business. No different if I'm working overtime, I got a raise, I got a little extra cash. Cost can be adjusted, it goes or revised. Remember, up and down. If I'm exceeding my goals, do I keep it on that? No, I could pay it off sooner if I wanted to. Spending is coordinated, I know where the money's going. Planning is structured and integrated within my budget. I know how much to plan. If I want to do something instead of doing the whole house, cost me a lot of money. I'll do it in pieces, stages in. Costs are standard set. Expenditures are monitored through a budget cycle. I only have some money. I don't take any more debt on. I basically just, if I have the extra money, I'll spend it into the one of my expenditures. Plan versus actual budgets. I'm always looking. Here's what I planned, and here's actually how much money I need. So then I might have to adjust my budget next year or for the next month if for some reason this was a bad month, storms or everything else. How do I recoup from that for the following month? Because I'm looking at the year end. I want to make it happen. That's when they say Black Friday. Black Friday, some people, some businesses, that's when they at least break even at the last. On the Black Friday when they have more people selling and they get rid of a lot of their supplies, and that's their biggest thing. So if they don't make it, then they're in the red. That means they're losing money. And then they're black, at least broken even, and lose money. Okay. And then cost performance can be compared with the industry averages. We did that some with the ratios, and you look at what my competitors are doing. How much are they spending for advertising? How much are they spending for their employees? How many employees do they have? How many stores they have? How much inventory? How quickly do they turn over? And there's a lot of information you could find out even by going and talking to individuals. Trust me, information's out there. Right now, I'm just exposing you to. When you take me for finance, we'll get in a little bit more detail. Okay. Preliminary budget is basically specify the budget authority, who's in charge. You can't go over it, you can't on there, you got to get permission, define the time frame. My budget's going to be for a month, for a year, usually it's yearly. Determine the frequency, how often I should be adjusting it, establish the cost category for each section, like a little bit of accounting, a little finance at the level, and prescribe budget flexibility. Okay, ongoing budget, always setting the goals, specify standards. What did I do? Monitor the results. It's similar to that. I was looking at that again. I thought maybe I typed it in twice. Remember, those who have me, I don't edit. I'm live, so take it as it is. Make actual expenditures, monitor results, and I adjust my budget. Just like you do if I didn't make my budget that I thought I needed for sales, or had something broke down, so I had more expenses for that one, I try to make it up on the next one, or try to adjust my budget so I spread it over. If it's in July, so at least I make it by the end of the year, it'll be taken care of. Okay? Effects of cash flow. Here's where people make a mistake: the cash flow. If I'm looking at cash flow, a lot of people, businesses, they've got everything else, they just don't have the cash. If I don't have the cash to pay my bills, I don't have the cash to pay my employees, I don't have my extra cash to take care of some of the resources, I'm stuck. So because I'm stuck, I'm late on my bills, I'm late at that, or affects my credit. My suppliers are maxed, I'm not paying them on time. They need the money to pay their debt, their bills. So what happens? Everything goes up. I got poor credit rating. I need the money. Cost goes up. My inventory, they could say, no, we're not going to give it to you just in time. You wait instead of we're giving you 15 days or a month. Now you got a month to pay it because you're never on time. You're going to have to pay me in 20 days instead of 30 days. They adjusted it on me. Like it or not, find somebody else. Okay. Now, when I look at resource allocation, you're looking at expenditures and operating as your short-term administrative costs. And you see a lot of companies that lay off people, they lay off managers that aren't productive. Even when you look at what President Trump did, I don't know what he did in the layoff, when he had the government shutdown for the 30 days, I didn't notice anything different. Now, if he didn't notice anything different, so maybe he's looking, hey, do I need all these people in that government position? Did it have any kind of effect on the economy? Didn't have any effect on my customer base? Let's eliminate some of these agencies we don't utilize anymore. They just kept them, they grow and grow, and no one ever got rid of them. And just, it's like a fungus, just grows unless you control it and put it back in check. It's just, I'm a business person. And remember, when I talk about, even when I throw in President Trump, what a lot of people don't understand is that he's a business person. And a business person, if I tell someone I'm going to do something, I got to do it. It's not like a regular politician that tells you, I'm just throwing this in there because, on both sides. It's not like a regular politician that tells you, yeah, we'll do it. And after the election, you don't hear about them until the next election and give you a few trinkles here and there. Oh, look, I got 10% out of the 90%, 100% that I told you I was going to do. Come on, I want everything. So from a business person, he's basically looking at the allocation, look at the money, and he knows how to control the budget because that's what he is. So some people don't like that, but and I know he's a little crude in some of his language, but I'm a business person. I want it right to the point. I don't beat around the bush. I just tell you, here's the issue, here's what I think I got to resolve. I'm focused, I got a goal, and I'm going to make those goals at all costs. Okay? Now, enhancing productivity is kind of nice. Employee performance, make them do a little more. Most employees probably work out of an 8-hour day. I think the research is showing maybe 5 if I'm lucky. By time breaks and all that stuff. Jeez, my goodness. Sales per square foot, every square foot. Look at when I put inventory and everything else there, it takes. I look at a retail store by square footage and how much merchandise. I don't want to make it cluttered, but if the more, look at a dollar store, it's everything, something like that. It's hard to find. Most stores, you have wider aisles, everything else, but I'm giving up square footage for product or inventory or products that I could sell on there. Having suppliers perform certain tasks. If you look in the morning, you go to Jewel or Mariano's or any of those stores, you see the suppliers come in there and they basically do all the stocking and everything else there, bring the shelves in the morning. And where do they get the information? They get the information from technology, from IT. And so when you scan it at the register, it's automatically sending it to the suppliers. Hey, we're out of Coke, we're out of Pepsi, or in my case, we're out of Twinkies. And so when he or she comes in to replenish, it's not their people. They just do all that work for me. And, they may charge me a little bit more, but then they know that they have their products. The way they look at it, they've got it neat. They've got all the goods in there instead of relying on the store that may not be able to keep all the supplies up because they have it in the back. It's getting old or whatever. So everything's fresh. They get rid of the old, bring the new in, and they do pretty good on that. And upgrade training programs. Training programs are good. You have to understand new technology. Train your employees how to be more effective and efficient. The consultant comes in. Evaluating team profitability and turnover. Okay, geez, I got it done. Think I got it done in a half an hour. And let me see. Let me just bring this back down here. Now, the thing I wanted to tell you is that everything we call here is in finance. Remember, this class I'm teaching now, that I teach at Harper, is for many of the students here. This is the first business class they're taking. Some of them are the fashion program. or purchasing program that Harper has, a fashion program. So they're taking one or two business classes. They're basically understanding something about a business. So I went real quickly, not to scare them, not to intimidate them, but they're going, man, all these other businesses, all this kind of different wording. What does it mean? Just to plant the seeds. After a while, now you kind of, okay, I can understand it. Then you take an accounting class to go a little bit more. Then you take an accounting too. Then you take a business class. Then you take some finance classes with myself, or you take personal finance. And you see how it's not that hard, but it's something you're not used to. You're intimidated. Don't be intimidated, because in business and retail, anything you want to do, accounting, it's all about the money. If you're not making any money, you're out of business. You're out of business, you're broke. If you don't watch what you're doing, your creditors will make you in default. So you have to know how to, just like in your personal life, you want to have some things, you have to know how to budget your money, how to spend your money, how to manage your expenses, how to buy your assets when you need them at the right time, and utilize your assets so you're making money on your assets, especially from the business. Okay, so that's it. So this was my quick half an hour. Let's see how much time I did. Let's see what time I got. And I got 30 minutes. I did perfect on this, all right? So my name is Dr. George Mochocki. This is Marketing 106, Chapter 12, Operations Management and Financial Dimension, which is just a little bit, I think they said it that way not to scare you, a little bit of accounting, a little finance. All I did is, talk about IPO. We didn't talk about bonds. There's a lot more. There's a whole 16 weeks you take me for finance and accounting, and then you'll understand it, because the whole thing of business, you have to understand how to control that cash and how to bring more cash in. You're using money to make money, like a farmer. He has to plant the seeds to get his crop, and then at the end, when he pays everybody else, ships it, and waters and all of this, then he looks at his yield, and that's what you're looking at, at the bottom when you go, what's my net profit? What do I finally get at the end? What is it? Okay. All right, so that's it. So take me. I got another class. I got another chapter coming up. I think next week we'll be doing again a little more about operation and merchandising plan. I think we're on chapter 12. There's 20 chapters in here, so we got let's see, 12 from 20. We got 8 more chapters. All right, and thank you again for taking this class at Harper and taking it with me. And I do teach a variety of classes, so look me up. And I also teach in another school, so you look me up. We're doing well. Different streams of income. Thank you again for taking this course. Bye.